Okay, hello everybody. I hope you guys are doing well. So in this topic, we are going to be looking at internal auditing. Normally when we talk about auditing, people think about external audit, or that's what people refer to immediately when we talk about audit. But as you will remember from our introduction or from our first topic, we looked at the different types of auditing, of which internal auditing is part. So it's also a concept under auditing, and we are going to be seeing how it differs from external auditing, and we're going to be looking at what is involved in internal audit, what is involved in external audit, and what does it bring to these organizations that do actually carry out internal auditing. First and foremost, it's an internal appraisal activity that is mainly designed and implemented by organizations to improve the entity's operations internally. And internal auditing looks at mainly areas of governance, risk management, and internal control processes and procedures. So that is basically what internal auditing is going to be looking at. It is aimed at improving the internal operations of the business. In simple terms, it is like an internal health check. You just want to make sure that in your operations or in your business, things are running properly. Someone is just keeping an eye to ensure that everything is running the way it is supposed to be running in the areas of governance or how the company is looked after, in the areas of risk management, and in the areas of internal controls. So that is what internal auditing talks about. In terms of the differences between internal audit and external audit, they differ in several ways. One is the objective of an internal auditor and an external auditor. We earlier looked at external audit as there to express an opinion on the truth and fairness of the financial statements of an entity. But internal audit is there to improve the entity's operations by looking at the efficiency and effectiveness of internal controls. When it comes to reporting, external auditors report the shareholders, and in case of a company that is that is in case of a public company, the audit reports may be made public. In case of financial audits, for example, we have public limited companies in Uganda, the likes of Umemi, the likes of DFCU Bank, the likes of Stanbic Bank, the likes of our KCB Bank. I think you have seen them publish their financial statements once in a while. However, for internal audit, the reports are addressed to the board of directors or those charged with governance, because they are the ones in charge of running this entity. And if there is anything that needs to be improved in terms of risk management, internal controls, or governance, these are the guys who are going to be in charge of making sure that such rectifications or such changes or such modifications in operations are actually implemented. So the reports are going to be addressed to those charged with our governance. When it comes to the scope of work of external audit is only and only limited to verifying the truth and the fairness of the financial statements, and internal controls are only looked at to the extent that you are going to rely on them for purposes of the financial statements. But external audit, you're not there to verify the operating design effectiveness of internal controls. You're only and only looking at them to the extent that these are going to affect the financial statements that you are verifying, truth and fairness. Whereas when it comes to internal audit, the focus is on the entity's internal control, but the scope can always vary depending on an entity. We have cases whereby internal audit looks at risk, where internal audit looks at internal controls, which is the core of internal audit, where they look at things like forensics and investigations, fraud examination, and very many are others. But on the other hand, external audit is only there to express an opinion on the financial statements, and therefore the scope of work is going to be limited to financial statements. They might give you some of the reports regarding internal controls, letter of internal control weaknesses, which is going to be issued in accordance with ISA 265. But it's already very clear in that report that those are the weaknesses that came to their attention in a bid to audit the financial statements of this entity. When it comes to relationship with the entity, external auditors are appointed by the shareholders, and largely because we want them to be independent. If you look at our very first topic, the introductory topic, we said that external audit comes into play because of having these companies, having owners who are not in charge of running these organizations. The shareholders are there, and then we have a team of management and those charged with governance that are running this. And then at the end of the day, they have to give a report to the shareholders about what has transpired in the company for, say, a year or from time to time. And we said that because of the need to enhance the credibility of this information and to ensure that the shareholder uses this report with enough comfort, that's how external audit comes in, to express an opinion in order to enhance the level of reliance that this shareholder who is not aware of what has been happening can actually rely on this report from management and those charged with governance. So by default, in order to make sure that this person is independent as they can, the shareholders are in charge of appointing these people by themselves. When it comes to internal auditors, they're normally appointed and they're hired as employees of the company. Because of that, them being employees, of course, the independency is less. And also we can have cases whereby internal audit is outsourced in order to enhance the independence. Yeah, we are saying that they may not be as independent as external auditors, but we also need some level of independence from them if their work is really to be of good quality. Having said that, these can be, internal audit can be outsourced. You can have employees. We have seen entities that have fully fledged internal audit departments, but you can also outsource a firm or an individual to carry out your internal audit services. Either way, it is acceptable, just that, of course, in some entities, there might be some restrictions that require you to have your own internal audit department. When it comes to regulation, external auditors are regulated by law. For example, the Companies Act does regulate external auditors. And then, of course, to be an external auditor, you have to be certified and you have a practicing license from the Institute of Certified Public Accountants of Uganda. Whereas on the other side, internal audit, there's no requirement. There's no regulatory requirement except for a few entities. For example, the financial institutions, you have to have internal audit that applies to the banks and the insurance companies. The listed companies, those that are regulated by CMA, Capital Markets Authority, you have to have internal audit. But for the rest of the entities, if they're going to do it, it's going to be done for their own good, but there's no legal requirement. Also, internal audit, there's no requirement that you have to be a member of ICPA. You have to be a member of the Institute of Internal Auditors. However, people prefer people who are going to have some level of responsibility. They will prefer those who are CPAs or those who are members of the IAA, but it's not legal requirement for them to be members of a certain body or regulated by a certain body. That is how internal audit differs from external audit. And I think those who have worked in environments where we have those kinds of audits happening, you must have taken note of some of those differences also in how they do things, or in terms of what they do, how they report, and how things are structured. And you could be able to mark the difference between internal audit and external audit. In terms of activities or what they do, we had earlier highlighted that they look at governance issues. Governance, mainly we are looking at how this company is looked after to ensure that it achieves its objectives on ethics, performance, management, and accountability. They're going to be looking at things like policies and procedures that govern the entity. They're going to be looking at things like human resource process. They're going to be looking at how people are brought into the organization and how are they taken out of the organization. How is our board composed? How often does the board meet? What do they do? Are they making the right decisions for the organization? I mean, just to make sure that the well-being of the company is taken good care of. They're also in charge of assessing the entity's effectiveness in terms of communicating risk and control information to those charged with governance, management, external and internal auditors. There has to be a communication system within the entity's governance structure to make sure that the right information is shared across all stakeholders or across all organs that are looking at this or that are looking after the organization. When it comes to risk management, of course, we're looking at how the entity is identifying and evaluating significant exposures to risk that could be affecting the organization, looking at, of course, the possibility of these risks occurring, and how are we prepared as management to make sure that the company is protected against these risks, and what could be the impact if these risks happened in the organization. And of course, helping to investigate fraud in some cases, maybe where there is suspected fraud. When it comes to internal control, of course, internal audit is in charge of looking at internal controls. One, how effectively these have been designed. Two, how effectively these are operating. That's why we say that they are in charge of looking at the design and operating effectiveness of internal controls. It's one thing to have controls designed effectively, that is, you have put them right, okay? And it's another thing to have them operating effectively. You could have them designed correctly, but you're not implementing them, you're not making them to work the way they are supposed to be working. So it's a two-way thing. So you have to make sure that they are designed effectively, and two, they are operating effectively. And if they find them not to be designed effectively, they can of course make recommendations for improvement. If they are not operating effectively, of course, they can make recommendations for what could be the leakages that need to be rectified for the system to run the way it is supposed to be running. Of course, they're also in charge of looking at the financial statements and maybe other operating other operating information, looking at the financial statements for compliance with the financial reporting framework in terms of recognition, measurement, and disclosure. And of course, they can also carry out some audit procedures to ensure that management reports are true, factual, fair, and in conformity with the reporting framework that the entity is using. Then, of course, carrying out value for money in terms of the entity's operations. Looking at the three E's: efficiency, economy, and effectiveness, and how these are being achieved in the organization. And of course, not forgetting looking at the compliance with laws, regulations, and, and management within the organization. Now, you'll find that in some entities, say, let's talk about maybe the bank, they're going to be having a separate department for compliance. But in some institutions, compliance could actually be under internal audit. So that's why we say that the scope of work of internal audit can actually be different depending on an entity. Okay, so that is normally what is covered by internal audit. You can have some other aspects of the entity's organization's operations being under internal audit, as long as these activities do not affect the independence of the internal audit department. I know I have had cases, or I have seen scenarios where people are asking me that, can internal audit be part of the approval process of a transaction, for example? And my answer has always been no, they are not supposed to be part of the approval process, because if I am in charge of approving a transaction, for example, then how am I going to come in tomorrow and review this same transaction to confirm if the right policies and procedures are being followed, or if the standard operating procedures are being followed? So internal audit is supposed to make sure that they maintain their independence, and that is when they are going to be able to perform their role effectively. We have had cases where in Uganda, especially, internal audit seems not to be doing what they are supposed to be doing. All of a sudden, internal audit is like part of management. They are taking part in management decisions. They are participating in day-to-day running of the entity's operations. And of course, that makes them less independent, therefore not able to deliver the way they're supposed to be delivering on their oversight role over the entity's operations. Okay, so how do you say that I need internal audit or I don't need internal audit? So you've got to assess the need for internal audit within your organization. And here are some of the things, of course, you've got to look at before you make a conclusion as to whether you need internal audit or whether you don't need internal audit within your organization. One is going to be the cost of setting up an internal audit department compared to its benefits. Is it worth having this internal audit department, or am I just going to create a cost center of which the benefits are going to be less than the costs I'm incurring to set up this department? That is from that is ideally the first point from a business point of view. You want to see how much you're investing in, how much you're generating from it, and then conclude if it's worth having or if you can actually do away with it. Certain complexity of the entity. Normally we say that complex entities may have a large need for internal audit department to monitor its activities, because if the entity is large, it may not be easy to get the comfort that everything is going on correctly from all parts of the operation. But if it is a very small entity or less complex entity or operation, it could be easy to look after by anybody, basically, and say that, hey, everything is running the way it is supposed to be running. So that's why you'll find that in most of the small businesses or owner-managed businesses, there may be no need for internal audit, because at the end of the day, there is direct control, maybe with the owner, or someone can have an overview of what is happening in every section of the operation, even without engaging very many people from different angles. Then what could these people be doing? Is it something that can be done by existing employees or departmental managers, or is it something that specifically needs a separate department to do? There are cases whereby maybe the controls or the processes are really not complex, and people who are there can actually take a look or can take on a role of looking after the operations. But in certain cases where maybe the operation is big, it's complex, you may need a separate department specifically to look after the operations. How about the risk of fraud? Because remember, at the end of the day, we are trying to make sure that such things are eliminated from the entity's operations. If the risk of fraud is high, it might call for a higher need for internal audit. And if there is really no or very low risks of fraud, then you might not need to have an internal audit department. And pressure from external stakeholders to have internal audit. Yeah, we have already said that in some of the instances, it's a regulatory requirement. For example, in financial institutions, in listed companies, a need to have internal audit could actually be a regulatory requirement. In some of the not-for-profit organizations, especially those that are really donor funded, you might find that you need internal audit. However, in other entities, it's really up to you. It's up to those charged with governance to make a conclusion as to whether they need internal audit or not as part of their operation. In terms of what they do, authority, what the corporate structure of the company looks like, internal audit will have different functions, and they can have authority different from one entity to another. But normally you're going to find that internal audit has full and unrestricted access to all functions and departments of the organization. They have full and free access to the audit committee and its chairperson in case we have one. And you will find that most of the times the reporting line for internal audit is the audit committee, not CEO or management. They report to the audit committee of the board, and then the audit committee is going to report to the board of directors. They are allowed to allocate resources for the activities, maybe set of frequencies, select subjects, determine scope of work, and apply techniques to required to accomplish their work. Nobody's going to be looking at what they are doing and putting a lot of restrictions on their operations. Then they can get personnel to assist them in doing their work. If you are carrying out internal audit and you feel you need, say, an IFRS, maybe 9 expert, you can go and get them outside the company and bring them in and you accomplish the task. The one that is very common is in insurance companies where some of the operations need experts, for example, determination of actuarial gains and losses. For the cases of life insurance businesses, you can go out and get an expert. It's gonna do that for you. We have cases of entities that use revaluation model for their assets. You might need a valuer to carry out some of the procedures that you will need when you're trying to carry out internal audit activities. Then they have the right to report any employee who tries to prohibit access to any records which are required by internal audit for its access. So for its activity. So this is in line with the first one where we say you should have unrestricted access to all departments and information that you need within the organization. There is some paragraph on how to manage an internal audit department. if you'd achieve the objective. That's very simple. Of course, you've got to make sure that when carrying out this work, the internal audit department is objective. They are not biased. They are not influenced by others to override their judgments. So they should be able to get the support that they need if they are to make those objective conclusions. They should be free from conflicting responsibilities if they are to remain objective. As I had already mentioned, that they don't need to participate in managerial roles, like making decisions regarding day-to-day running of the business if they are to do their oversight role effectively. When it comes to how they are recruited and their performance is managed and their performance is looked after, normally it's done by the internal audit. Sorry, it's normally done by those charged with governance, not the head of HR, not the CEO, not people who are involved with operations. This is mainly to enhance their independence. There shouldn't be any restrictions or constraints placed on the internal audit function by management. Then it's also good to have internal audit department, especially the heads, to be members of professional bodies. At least this puts some sense of responsibility and accountability to these guys. When it comes to competence, people should be properly resourced depending on the entity and the nature of its operations. Because if you are going to be having people who are going to be looking after the entity's operations, they need to have the competence to look after the entity's operations. There should be clear policies when it comes to hiring, training, and assigning internal auditors to internal audit engagements. They should have adequate training and proficiency in auditing, such as membership to professional bodies. Then they should possess the required knowledge relating to the entity's financial reporting. They should be knowing how to comprehend some of the aspects relating to the entity's financial reporting framework. When it comes to being competent, of course, you also need to make sure that these people are members of relevant professional bodies where they can get continuous professional development, they can get relevant training from time to time as they are running these organizations. In public sector, we also have internal audit. I think it's one of the areas that that must have internal audit. By regulation, if you've looked at most of the ministries, if you've looked at local governments, they all have internal audit departments, and it's a requirement by the regulation that looks after government funds, more so in Uganda. As you will know, maybe from a public sector accounting and reporting, there are 7 principles that must be upheld by people in public offices, and internal auditors are no exception. So they also must make sure they are selfless, or they should act in the interest of the public, not their own needs. They should put the interest of the public first before their own interests. Integrity. When it comes to integrity, they should be able to, they should be honest and straightforward. So they should say the truth. They should make decisions that are against their own honesty and their own correct professional judgment. And objectivity, they should be free from bias. They should make recommendations and choices based on merit, but not other external pressures or influences. They should be accountable for their own decisions. They should be open about the decisions and actions they are taking. They should be honest, and then they should lead by example if they're holding public offices. One of the things that is also noted in ISO 16 is that internal auditors can actually work with external auditors. This happens in a sense that internal auditors, they have been in this organization from January to December. They have been looking at quite a number of things, which might also be falling within the scope of the external auditor. And it is good practice. Why can't these people work together to make sure that if someone has done something, what would be the reason for me to redo the same thing and try to come up with the same results? I have seen it in some of the multinationals. They try to use this also as a tactic to reduce the cost of delivering an audit. If I am a bank and I have a full internal audit department that has been testing controls right from the beginning of the year up to the end of the year, why should the external auditor also come and is trying to test the same controls? Why can't he rely on the controls testing that has already been done by internal auditors and minimize that duplication of work and redoing something that has been done by somebody already, and do the audit very fast and finish? And of course, that is going to reduce the amount of time taken by the external auditor. As such, that is going to maybe reduce the fee that would have been charged by the external auditor, since external audit work most of the time is always going to be billed depending on how much time is going to be spent on a job. But before you just place reliance on this internal auditor's work, there are several things that you have to look at and be comfortable that yes, these are in place, therefore I can work with this guy. First one is objectivity and independence. In external audit, we say that if you're not independent, you cannot carry out an audit, okay? That is why we define external audit as an independent examination of financial statements with a view of expressing an opinion enhanced to aimed at enhancing the reliability of information to the users other than the responsible party. So if someone is not independent, they cannot carry out an audit. So before you rely on the work of this internal auditor, you have to first confirm that in the first place, he was independent while carrying out his work during the year, okay? And that can be looked at by who does he report to? Are there any constraints put on the work that he's doing? How is management reacting to his recommendations? And you can be able to assess and gauge and say that, yes, this guy is objective, this guy is independent, and therefore we can be speaking the same language, and therefore I can look at his work. Number two, technical competence. Does he have the knowledge, the skills, and experience to do this kind of work? If this guy is not competent, if he doesn't have the skills to do the internal audit, I don't think I should even be spending time to look at work done by an incompetent individual. Professional due care, where his activities properly planned, supervised, reviewed, and documented. Does he have audit manuals? How is he sampling? How is he documenting his work? I mean, is there something I can look at and be comfortable and be happy? I have seen scenarios whereby you come to an organization, ask for internal audit, try to look at their work, and it's maybe no working paper. Try to look at their documentation, it's really in bad state. You try to look at their reports, there's really nothing being communicated. But it's very important that before you plan to rely on the work of internal audit or work with them or use their work, they have to be exhibiting high levels of professional due care. In communication, assess if these guys are going to allow you to communicate with them and give you their work. It's one thing someone to say they are willing, but it's another thing if they can't give you their work, then there's no way you're going to work with them. It's also very important to note that you using the internal auditor is not specifically looking at the work that he has done. You can also request him to do some work for you. You could select some samples, maybe on test of controls or anything else, and you request him to execute it for you, and he gives you the results. However, you have to first ensure that these four criteria or these four items have all been fulfilled by this internal audit department that you are going to work with. But of course, so before you rely on their work, even if they give you their work, you have to first review it and confirm that work was carried out by people who have adequate technical training and proficiency. Are people qualified to do this work? And the work was properly supervised, reviewed, and documented. This is very, very important because that is what is going to determine the quality of the work that you're having. And the audit evidence that was obtained is adequate to draw conclusions. I don't want to see you concluding after looking at one sample and you say that the evidence is adequate. Then conclusions reached are appropriate depending on the work done and the reports that have been issued by internal audit. Then if there are any exceptions, they have been properly resolved by management. If they're not being resolved by management, then we have an issue and you might not be comfortable relying on these internal auditors' work. And here are some of the procedures you can do just to make sure that the above requirements have been fulfilled. You can reperform some of the procedures done by internal audit. Reperform one or two and see if you're getting the same information, if your findings are consistent. You can make inquiries of people within the internal audit department. I can ask you, what are your qualifications? What are the guys been through there? How do you do APs? And then you get a feel of how these people are hands-on when it comes to the kind of work they've been performing. You can observe some of the procedures being carried out by internal audit. There are those that can actually be observed. Then you can also review the work, like working papers and audit programs by internal audit. And you have to remember that in cases whereby you have used the internal auditor's work, it is still your opinion that is it is you expressing an opinion on the financial statements. So it does not affect maybe the level of liability of the audit opinion. You still have the responsibility, even on top of the work that has been done by the internal audit. You can't make a reference to the internal auditors. It is you. You have relied on his work, but you take ownership of the internal auditor's work that you have relied on. When it comes to reporting, the reports really vary from one person to another because there's no specific format. So this is the report of an internal audit, but you're going to find that an internal audit report is going to be in the form of management letter written by an external auditor. You're going to have pretty much some of these items like a reference, terms of reference, which is basically going to be giving a background of how your internal audit has been carried out, like what defines what you have done, how have you been appointed, what have you looked at, and how do you come to do what you have done. It could be in accordance with maybe your letter of engagement that specifies what you're supposed to look at as the internal audit department. For some entities, they have an internal audit charter, which is going to be giving guidance on the operations of the internal audit department. Can have an executive summary, which is basically a screenshot of what is in the report, then a report and appendices. Maybe most importantly, the report is going to have the findings or your observations as an internal auditor. So the issues that you have as seen. Then it's going to have the implication of finding, what is going to go wrong if that remains. And then it is going to have the recommendation. What are you advising management to do in that regard? Like any other management letter or internal control weaknesses, the findings in the internal audit report normally are discussed with management so that their views are incorporated in the report to make it acceptable to management. Otherwise, if you give them a report that they do not agree with the findings, then you're going to have a lot of back and forth with management. And those reports are normally addressed to the board of directors or its equivalent. And then copies can be sent to the managers later. So, okay, so thank you very much. So I think that was our internal audit. That is topic H in paper 12, auditing and other professional ethics and values. And then it's the same topic is topic H in paper 17, that's audit and other assurance services. Thank you very much. I hope you find this content very helpful as you prepare for your exams. Please go through the content on any electronic media, on any platform. If you have any questions, please feel free to contact me on my contacts. It can be through email, through YouTube channel. You can post your questions there. Through my WhatsApp numbers. Email is nvictor200@gmail.com. That's N for Nahabwe, then victor200@gmail.com. And my WhatsApp number is 078 99 35 004. You can post your question on email, you can post your question on WhatsApp, and you can always get responses about any material with respect to auditing, CPA, paper 12 or paper 17. Thank you very much and all the best.